Yesterday didn't just pass quietly. Something shifted. While most Americans were going about their day, something happened overseas that could reshape what ends up on grocery store shelves across the United States for years to come. In Beijing, Canada finalized a deal with China that, on paper, looks like a routine trade adjustment. In reality, it may mark the beginning of the end of how North American agriculture has worked for the last 7 decades, and almost nobody is talking about it. Here's the short version. Canada agreed to significantly reduce tariffs on Chinese electric vehicles. In return, China agreed to slash its punitive tariffs on Canadian agricultural exports, especially canola and wheat. Sounds boring, technical, easy to ignore, but buried inside that agreement is a shift that could quietly push American buyers out of Canadian grain markets and reroute the entire food supply chain away from the United States. To understand why this matters, we need to rewind. For decades, the US and Canada haven't just traded food. They've co-produced it. Wheat grown in Canada is blended with American crops. Canadian grain moves through US ports. American processors depend on Canadian varieties to meet export standards. This system wasn't optional. It was designed that way. Then, less than a year ago, that system started cracking. When Washington imposed sweeping tariffs on Canadian agricultural products, the official explanation was leverage, trade imbalances, border concerns, negotiation pressure. But the real-world effect was simpler. Canada suddenly found itself squeezed from both sides. To the south, American tariffs restricted access to its largest market. To the west, China's tariffs, some as high as 85%, nearly wiped out Canadian exports overnight. And these weren't symbolic penalties. Canadian canola exports to China collapsed. Pork shipments dropped sharply. Seafood exports stalled. Farmers were sitting on unsold inventory while costs kept climbing. That's the context most people are missing. So when Canada went looking for stability, it didn't find it in Washington. It found it in Beijing. This new agreement doesn't just reopen Chinese markets. It offers something farmers care about even more than price: predictability, multi-year contracts, guaranteed buyers, clear rules. And that's where the real damage begins. Farmers make decisions months, sometimes years in advance. What to plant, how much land to dedicate, which equipment to invest in. When Chinese buyers offer long-term contracts with premium pricing, while American buyers face ongoing tariff uncertainty, the choice becomes obvious. Canadian production doesn't wait for politics to settle. It pivots. Once crops are planted for Asian markets, once logistics are rerouted toward Pacific ports, once infrastructure investment follows those routes, reversing course becomes extremely difficult. This isn't a trade spat that disappears with a press conference. It's structural, and the effects are already showing up closer to home. Grain prices have jumped. Wheat-based products, bread, pasta, cereal, have become noticeably more expensive. For the average household, that adds hundreds of dollars a year in food costs. And that's before the full impact hits. But consumers aren't the only ones feeling it. Across the Midwest, grain processors that relied on Canadian wheat are scrambling. Some have seen raw material costs spike by more than a quarter. They can't fully pass those costs on without losing contracts. Absorb them, and they risk shutting down entirely. These aren't giant corporations that can pivot overnight. They're family-run operations, rural employers, entire towns built around one facility. And once those plants close, they don't come back. Farmers in northern states are getting hit too. Many relied on blended crops to meet export standards. Now they're paying premiums for replacements, or losing buyers altogether, while watching Canadian producers redirect supply to Asia. Even transportation networks are unraveling. Cross-border trucking routes are drying up. Small logistics companies that specialized in agricultural transport are seeing volumes collapse. Rail operators and port facilities built around integrated North American trade are facing uncertainty they've never had to plan for. Every link in the chain is under stress at the same time. But here's the part that turns this from a problem into a strategic failure. The largest global agricultural traders, the companies that actually control food flows, are adjusting quietly. They're reducing exposure to North American cross-border trade because instability matters more than efficiency. When capital moves, infrastructure follows. Processing plants, storage facilities, shipping capacity. All of it shifts toward regions with fewer political surprises. And while the numbers today only show modest declines, the real losses are still forming, locked into planting decisions and long-term contracts that won't show up in trade data until it's too late. Canada has been clear about its direction. Its leadership has openly said the goal is to reduce dependence on unpredictable markets and secure long-term buyers elsewhere. And from China's perspective, the timing couldn't be better. Instead of confronting the United States directly, Beijing is strengthening its food security through partnerships that bypass Washington entirely. Long-term access to Canadian grain, investment in infrastructure, supply chains that don't depend on American cooperation. That's not accidental. It's strategic. And it puts the United States in a weaker position heading into upcoming trade negotiations, especially with North American trade agreements now under review. Canada no longer comes to the table empty-handed. It has alternatives and leverage. History offers a warning here. When major agricultural supply chains break, they don't snap back easily. Markets move on. Relationships fade. New suppliers step in. And rebuilding trust can take decades, if it happens at all. The irony is hard to ignore. In trying to apply pressure, the United States may have pushed its closest trading partner into a permanent realignment, one that weakens American farmers, raises consumer prices, and hands long-term advantages to global competitors. This isn't about abstract trade theory. It's about food security, rural livelihoods, and a supply chain that took generations to build, now fracturing in real time. So here's the question worth asking. Is this strategy actually protecting American interests? Or are we watching one of the most consequential self-inflicted economic shifts in modern history? Because from where this stands, Canada adapted, China capitalized. And this is where the consequences move beyond individual farms or businesses and into long-term national risk. When supply chains fragment, the impact isn't just higher prices or lost contracts. It's reduced resilience. Integrated agricultural systems exist for a reason. They allow producers to absorb shocks, whether that's drought, extreme weather, geopolitical tension, or sudden shifts in demand. When those systems fracture, the margin for error disappears. What replaces them isn't self-sufficiency. It's vulnerability. The decisions being made now around planting, infrastructure investment, and long-term procurement will shape food availability years from today. Once Canadian production aligns with Asian demand, once shipping lanes, storage facilities, and processing capacity are optimized for those markets, reversing that orientation becomes costly and slow. That shift also weakens the United States' position in future negotiations. Leverage doesn't come from pressure alone. It comes from indispensability. And as alternative supply routes stabilize, American buyers lose bargaining power while competitors gain it. From a strategic standpoint, this isn't just a trade dispute. It's a reordering of food security relationships, one that reduces flexibility, raises exposure to future shocks, and transfers long-term advantage to actors who now control stable supply. That's the risk being priced in quietly now, long before it fully appears in trade data, grocery prices, or political consequences. So how do you see it? Is this a calculated long-term strategy or a costly miscalculation with consequences that will last for decades? Let me know in the comments and see you in the next.